had a friend who his hard drive died. So all the stuff in his hard drive was just destroyed. So have like a backup, I guess. That's an important thing. Some people have reliable cloud space, be able to access your reliable cloud space, but don't rely on one hard drive to store important stuff, right?
Mm-hmm.
That's a lesson today. Okay, so on your notes, I want you to write more notes. I feel like we're talking for an hour. So can you increase that?
Yeah.
Where you can almost, I want you to give back the presentation, basically. The presentation I give you, I want to be able to give it back to yourself or the next person you're going to train. What?
I'm trying to make it concise, but I mean, I could still make it neat and just have everything. And I'll do that for the upcoming weeks.
Great. And you showed your core 10, and it just had the symbol, the stock symbol. I want to see price change, which is a change for the day, and then volume, okay?
Mm-hmm.
Because you look back at that, and you'll see you had a core 10 on X date, but it doesn't show the price it was. So you don't really know what's happening from your notes.
Every single Thursday, I put them in.
Good, so do that.
And then I'm going to resend you a picture.
Okay, do that. And I look back at my journal, and I see the stock list, and I see prices, and I go, wow, that stock was that price? Oh my God, I should have just bought it, my core 10 looking at it.
Yeah.
Speaking of stocks, I want to give you a couple hot stocks today that are in play. I'll put here stocks in play. In play means they're just very favored and they're being traded heavily right now. First one, Tesla. Of course, you know that. It's already defied the odds. The short sellers have gotten killed and gone home. And now it's just trading at extreme multiples. And probably what will happen is they'll have some, I don't want to say decent earnings, but they'll have some kind of earnings. And then that's gonna cause that basically proves the price, so it'll probably increase from here. Still risky, still very risky. It can come down to 300, But Tesla's the first one. Second one is Roku, ROKU. These guys don't have a profit yet per se, but they have good income. They have a minus, I think, like 60 cents a share. And they broke out into like $460. And I had them for just a while because I was trading. This is one of the things you're going to come to face as a trader that, you wish you didn't sell, that's just what happens. I had a few trades on Roku. It was in the 50s, trade 50 to 60, 60 to 70, like that, 2 successful trades. I had a long distance. I had like a 3-month trade, held it for 3 months, made some decent money, and then moved on, kept going up. And now that $50 stock is $460. What do you say about that? Within a year. So here's one of the ones that the criteria, can it double in 2 to 3 years? Yes. And Roku is about, I want to say it's about 50 billion market cap. So it's at the perfect market cap where it can probably double again. Not saying it'll double, not saying it'll even maintain, but it's in play. Take a look, Roku, ROKU. Great chart. 2 stocks in play. That's the bonus for today. Okay, so today I want to review a little bit. I want you to get back to me what you've learned, the important parts, what you're taking away, some trading ideas, some styles, some philosophies. What do you got?
All right, so we're from the beginning?
Give me like a 2-minute rundown.
Gotcha, okay.
Just stuff that comes out at you.
So the stuff that comes at me automatically when I look at any type of stock, I look at their 5-year chart, their 1-year chart, their 6 and their 3-month chart. Obviously, the 5-year chart shows over time growth and stability. And then I also look at volume and average volume. Anywhere from 2 to 4 plus is very good. Market cap, I also look at to see if it's a
Hold on. 2 to 4 million a day.
yeah.
Okay,
That's
I
just
want
that
to. I
average
want to.
that we gave, but depending on what stock or like compared to average volume, you also take that into consideration. You look at the average, see how it's performing today, just to see if the stock is being traded. And then I take a look at market cap to see if it's a stable company. And if something happens, if bad news leaks, that the company won't get destroyed. Uh, and then I look at the price to earnings ratio, and I don't really care for dividends that much. It obviously depends on what stock I go into. Um, and also, the most important thing I think for me, I mean, this is also in my mild trading, where we're disregarding the covered calls and all those for now. Um, what I like to do in the 3 month is to see if the stocks can stay in between two resistant lines. So as we discussed previously with AMD, they're in that $87 to $97 range in the last 3 months. So just stuff like that, I think pops out the most to me.
Great. And what have you learned like about covered calls?
Cover calls to do them like a month and a half in advance. It's the third Friday of each month. Um, you told me that monthlies are less volatile. Um, we go in the money. Oh no, we go out of the money for more for share growth, potential upside, and for a premium. That's really the main things that pop out to me. And we also go for a 3 to 5% gain over time. So, for instance, for Apple, we do the math. It could be 36%, but I mean, not every single month is going to be a hit. So we'll put it at 25%, and 25% on your Apple covered calls is great, consistent income over the year.
Excellent. Good. And you had a question about a put. You had a stock price of 50 and a put of 17.
So the stock at the time was at 65, if I could recall, when I placed the put, when I bought the put option of a 17 strike. And now less than a week later, the stock is trading at $50, and the option itself lost value, which was confusing to me.
Yeah, it's going to do that because for one thing, you're way out of the money. If you have a share price of 50 or 60 and you're buying the 17, you're expecting it to come down a tremendous amount. Keep in mind that as you go towards your expiration, you said your expiration in April, so 2 months. Not really a lot of time, but it's better than next week, you know. You got to figure that all that fluff, let's say from 50 to 17, you got 34 points. If you have 2 months, think of it this way. The stock is going to have to go down 50 cents a day, you know, to go down 34 points to get to where it's going to be in the money, where it's going to be worth something. So that's just going to break even to where your option is 0. You know, to really make money, you want it to get down to like 15 or 10, you know, or come expiration, if the stock is 50, 40, 30, 20, 17, your option is 0. That's the thing. Mm-hmm. There is another scenario where, let's say within a month, the stock drops drastically again. Let's say it drops to 40 or 35. What I would do is just take that opportunity to get out. Now, if you pay you pay $2.20 for it.
Yeah, $2.25 per.
You know, it may go to $3 or $3.50 at the most, you know, because a lot of people are betting on that stock going down. What's the symbol?
Symbol is GME.
GME. A lot of people are betting on that stock to go down, and it has to go down a lot to impress the traders to where they're going to sell. And if it doesn't go down a lot, they're going to sell just anyways, just to get the money out, just to go to the next trade. So you're not going to get dollar for dollar. You're going to have a big movement in a short period of time to get money out of that option because you bought so much fluff, way out of the money.
Mm-hmm.
it would have been a little safer to go closer to the money to buy like the 40 or the 50.
Yeah.
That way, and I bet you wouldn't even pay that much more for it. But that way, when the stock goes down $1, you probably get like a 50-cent move or 70-cent move. Even if you had to pay $10, which is like $1,000, or $12, which is $1,200 for the option, it would have been better as far as safer because you would have had more value. That's why.
Yeah. Live and you learn.
And having a $60 stock and buying a $17 option is a real long shot. You know, it'd have to drop drastically for you to get some kind of return on it. That's what I wanted to say. Okay.
Yep.
I would consider getting out. If you still believe that stock's going down, what I would do, I would improve that. What I would do, I would sell what I have now, get the money out, and I would see if I can move it up to like a 45, you know, and don't do April 1st, do the April monthly or the May monthly. It gives you more time. Mm-hmm. Why? Because now you have more of an investment. It's not going to just get blown away by the whim of the wind. You know, stock goes down 5 points, your option might go up $1. If you have a 17 put and the stock is 50, stock can go down 5 points and your put can also go down, you know, because it's just so far out. Make sense?
Yeah.
Okay, any more questions on that?
Nope.
Okay, so the review was good. I thought we went thoroughly over stock selection. There's 10 criteria. Do you know that reasonably well?
Yeah. So what I didn't speak of was if the stock has the ability to double, dividends, covered calls, share price, stock splits, market cap, and all-time highs. Those are the
yes
that I didn't really speak of too much.
10-year chart, volume, there's 10.
Yeah.
Let me see if I can remember off the top of my head. You got volume, 10-year chart, PE, which means make profit. Does it pay dividends? Does it give good money for cover calls? Does it have stock splits? Can it double within 2 to 3 years?
All-time high market cap.
Is it hitting all-time high? Does it have a $25 billion market cap? And what's the last one?
It's just share price, basically.
Share price. You want to buy a high share price. You don't want to buy a low penny stock share price. Good. Okay, so do you have any more questions for me before we get into it? I have a couple things I want to talk about.
Not really. Okay,
so we talked about making money on covered calls, making like 3 to 5% per covered call to 5%. Let's say for 3 weeks to 7 weeks is the ideal. So sometimes you'd be writing like a 2-month covered call, technically if it's 7 weeks. And sometimes you'd be writing like a covered call within the month if it's 3 weeks. And of course you'll get less if it's 3 weeks, and get more if it's 7 weeks, but the trade's longer, so you have to wait longer, right? So like for example, can we pull up Netflix right now?
Yeah.
Let's pull up Netflix. NFLX. Can you give me the share price, the change for the day?
So Netflix right now, get it? Okay. They're sitting at 557.09.
Yes.
My fault. 559.07. My fault. 559.07. And their change on the day is $11.15, which is a 2.03% gain.
Can I get a volume?
Yeah, volume was 3.69 mil.
Okay. What I want to show you is that this is the perfect time to write a cover call on Netflix because it swung up. We're to get more money for the premium because, you know, when the stock swings up, the calls go up. And we're writing the call. So that's why it's good, because tomorrow it may come back down, for example, right? So, and if the stock, you know, dips down, it's not a good time to do the cover call. It's better to do the naked put. If you're doing a cover call, you can just wait. But if you're naked put, the puts go up when the stock comes down, so you get more premium in that sense. And if you consider the stock's going to go up and down, you want to trade it. You want to get the most for your money. So you want to write the puts when the stock dips, or write the calls when the stock peaks up, because you're getting more money for the options. Does that make sense to you?
Yeah.
Okay, great. So it's February 9th, 2021. So let's look at March monthly, and we're looking at 559. Let's just say 60. Let's just say 580, because I'm going to give it 20 points to move.
We're looking at
580.
we're looking at the March.
March 580, because it's 560 basically.
Yeah, the
I'm going to give it 2 points to move.
So the 580.
20 points to move.
Yeah, the 580 call in March is a premium of 1720.
Okay, great. So let's divide 1720 by the share price of 559.07. What do you get?
Yeah, so let me do the math right now. We take 1720, we divide that by 559. We get a 3% gain.
Give me something. 3 point what?
3.0.
You don't have any numbers after that?
It's 3.07.
3.07, much better. See, I like that better. Okay, 3.07%, just over 3% return. Now, a couple reasons why this is good. One, you're going to get your income 3%. Okay, it's technically 5 weeks. Okay, put here 5 weeks. Right? Am I right? Check me.
It's the third week of March, so we have. Let me go to Robinhood. 1, 2, 3. Yeah, 5.
Okay, and we're gonna get basically $1,700. Okay, for writing that cover call. Our investment is 55,000. Is 55,000. 55,900. Say 56,000. We're getting $1,700 every 5 weeks. It'll probably be $1,500 if we did it monthly on the month. Okay, which is like 2.8%. Still good. Okay, so what I'm showing you is we're bringing in income, and it's consistent, and we're also allowing a lot of share growth. Look at this. I could have wrote the 570 and brought in more premium, couldn't we?
Mm-hmm.
Let's look at the 570 now. Let's look at the 570. Bring it up for March. Tell me the bid, or the premium.
The premium is 20.9.
20.9. So basically $2,090. Okay, and let's divide 20.9 divided by 559.07.
20.90 divided by 559.07. 3.7% gain.
3.7% return, even much better. You know, so you can take a $1,700 cash in your hand. We have 100 shares on NFLX. That's our investment, and you can agree to sell it at 580, or you can take $2,090 in hand and agree to sell it at 570. If you agree to sell it at 580, you're going to get 20 points of opportune share growth. That's another $2,000. So I'm looking at in my mind, I'm going, you know, 1,720 plus 2,000 total potential profit. Potential, I'm not saying you're going to get this. It's going to be 3,720. Whereas if you're on the 570, you're going to get 2,090 in hand, but only 10 points of share growth, 1,000, which is 3,090. So that way you have potential of $3,000 if you do the 570 and it swings up, it gets taken out, which means it sells, and you get paid. You're either going to get paid 570 or 580, and that's called an assignment. Write that down, assignment. The shares were assigned to your cover call, to your strike. So like either one is good is what I'm trying to say. Go ahead.
The assignment, could you repeat that one more time?
When you're doing a cover call and the stock swings up and an expiration is past your strike, in this case, we sold the 570 for 2,000 and we sold 580 for 1,700. If it's past any of those strikes, then they're going to assign your shares. It's called an assignment, and they'll sell the shares at your strike price. And you're going to get your premium plus additional money because you're getting share growth now. You're getting 10 points if you sold the 570, and you're getting 20 points if you sold the 580 because the stock is 559. Technically, you're getting 21 points. You're getting 11 points, but I'm just rounding up. So they're both good, but let me tell you, if I'm on Netflix, I know it can move. I know that because I've been in it for so many years. I do want to allow share growth. Don't get greedy. I mean, you can sell the 560. Some people might sell the 560, but let me tell you what's going to happen. Give me the premium for the 560, please.
Let me go back on it. Premium for the 25.50.
25.50. So now you're investing 56,000. You get 2,500 back in your hand, right? But here's the problem: you only have 1 point share growth, and what this stock is likely to do. So the 1 point share growth is going to give you 2,600, 2,650. You follow me on that?
Yeah.
And what this stock's likely to do is go up 30 or 40 points or 50 points, and now it's going to be $600. And to continue this trade, you're going to have to buy it back for $600, and you only got 2,600. Whereas if you were a little bit more patient and a little bit more optimistic, you're getting 3,700 if you write the 580, because you're adding the 1,700 plus 2,000 premium, or you're getting 3,000 for selling the 570 because you're getting 20 points premium and then 10 points of share growth. Do you get that?
Yep.
Okay. So I just wanted to show you that. Now, I want to show you the other side of this trade, which is to say that, we're preaching, hey, you can get 3 to 5% return on cover calls, but it's not really that. I don't want to overpromise and underdeliver. So I want to tell you the downside of that. What if the stock goes down? Okay. So now we're at let's say we're at 559. And let's say we write the 580, like I suggested, and the stock goes down to, give me a price, doesn't matter.
Let's say it goes down to 549. It goes down 10 points.
549, down 10 points. Okay. So now we lose 10 points in share growth because we already said we invested 56,000, 55.9 to get the 100 shares of Netflix. It went down 10 points. So now we're out $1,000. Can you hear me? There's some wind in my patio.
Yeah, I hear you good.
So we're gonna take our premium of 1,700, 1,720. We're gonna offset that $1,000, and we're gonna end up being above the bracket by 720. Okay.
Mm-hmm. So we minus automatically 10 points off, leaving us with 720.
So we still made money, but our percentage went to hell because our stock went down. And what am I going to tell you to do in the next month? I'll tell you what I'm going to tell you to do. The stock is 549. I want you to write the 560 or the 570. And I don't care what price you buy it at, because look, even if you buy it at 559, the reason I want you to consider writing the 560, because you're only going to make 1 point on that, technically on that trade, because you bought it at 559. But the reason I want you to write the 560 this time is because you're going to get more premium. You're going to get consistent premium. You're going to get consistent income. In this case, it's paying about $1,700 a month. Okay, we can figure that out. $1,700 to $2,000 a month. Okay, right? Am I right?
Mm-hmm.
Whatever Netflix is around this price, it's paying between $1,700 and $2,000 for a covered call per month. So you're going to have to write the lower call to get that $2,000 a month. Okay, follow me?
Yeah.
Now let's say it drops 20 points on the second month. So now it's going to go down from 549 to 529. Okay. Now here's the important thing I want you to learn. Don't think to yourself, oh, well, I bought at 559, so I can't sell the cover call. Yes, you can. Stock is 529. I want you to sell either the 539 or the 549. Why? Because I want you to get your $2,000. Okay. Regardless, not regardless, but in spite of the stock price going down, I want you to still get your $2,000. You're still going to sell or write the cover call, the 539 or the 540. Actually, the 540.
So the silver lining through all of this is, regardless of whether the stock is going down, we're doing this for a consistent and constant income. It might not be a big gain, but it's still a gain.
Yes. So you're 3% a month times 10, because you're going to probably have a couple of months off, or you're going to probably do a couple of cover calls that have a 2-month. It sounds like it's 30%, but it might be 20% or 25%. Still good.
Mm-hmm.
Now let's
go.
go.
Tell me if I'm correct. We're making now, let's say this is true and the stock is going down like this. We have to have $55,000 to write this Netflix covered call, to do one covered call. So now, month after
you can
month,
do it with slightly less if you have margin, but to do it with cash, the whole price is going to be $55,900. Yeah.
Yeah, so it'll be $55,900, and we'd only be making, if the stock goes down, we'd only be making like less than $1,000, and this is per month, correct? If the stock is going down, and
you can make $1,000 per month instead of $2,000. Put it that way. Yes.
Okay, fine.
So it's still income, but not as much as we liked.
Yeah.
And then let's just go into the red. Let's just say we have a bear market, Mark. We have a bear market. Everything's coming down. Look behind me. Everything's red. Everything's coming down. So here's what can happen. Your best quartet stocks can start sliding, and people are getting killed everywhere on the street. By the way, I introduced Mr. Morgan last week because this is like your ego, your subconscious saying, hey, you need to make money regardless. Otherwise you get fired. Otherwise you're a failure, right? So what do? Now you have to get smart now. Now you have to trade better than the rest of the bunch, right? Because the street is losing money. The market's going down. You see? Follow me?
Yep.
Okay, so one thing you can do, this is not a trade against the market. I'm just going to explain to you. If you're getting consistent, money from cover call, 3%, $2,000 a month, right? Noticing the Netflix is sliding with the whole market. Let's say we have a whole year of a bear market and the whole market went down, 30%, You might only make 20 to 25% return on these cover calls. So you might be at a 10% loss, for example. Okay? You hear me?
Yeah.
But here's the thing. You had some income. You survived. You licked your wounds. You see what I'm saying? You survived. Since you had this income coming in, the bear market didn't really hurt you that much. You see what I'm saying? And that's a huge difference to the people who got killed, had lost. If the market lost 30%, you can guarantee there's people who lost more than 30%.
I mean,
you
told me last week, one of the most important things to have in mind when you're trading is to reduce your chances of losing.
Yes.
and to protect your investment. And this is how you
Yes.
protect it. So
Yes. So if you have, and that's when you want to have dividends. That's when you want to have cover calls. And if you're trading, you better have some skill for trading, because now you're trading against the market, or at least you're trading in a falling market. So we're just going to say here, it's more difficult to trade in a falling market. Can you understand that?
yeah, it's mild
Okay.
trade. It's difficult in a falling market, but we should just have dividends and cover calls to keep us above water.
Yes. So you can use the cover call situation just so you'll survive. You know what I mean? You're not going to get killed. If you have a floor of traders, and most of the guys, haven't had my course, a lot of them, a bear market's going to wipe them out. They're going to get killed. But if at least you have this $2,000 a month, even if the stock's coming down, Mark, you're not going to get hurt that much. See the point?
Yeah.
So that's when you that separates the men from that separates the boys from the men. Where you can survive in a bear market also. A bull market's nice. A good economy, even like this, is nice because it's not really that hard. Just pick a good stock and it just goes up. Am I right?
Yeah.
But unfortunately, there's trends in the market where that's going to flip, and now it's going to put that on its head. The whole market's going to be upside down, and you're going to see on TV, blood on the streets, Wall Street lost whatever X billion dollars, whatever. So and so is getting sued. So and so, pension managers are out, lost money, they got fired, and you're trying to make sense of it all. You're trying to watch Kramer, and Kramer's doing his thing. So in a sense, you can always stick to your core 10 if hopefully they're good. Hopefully they're very good selections. And in the case of like Netflix, you can do the same thing with Skechers, Apple, and even Roku and NVIDIA. You can get some Tesla. Tesla's like even better in the sense that you're getting 7% return, 6% return, 8% return on a cover call. So you have to stick to your guns. When the market turns in the bear market, you have to eke out what gains you can make more safely. And like you said, protecting your money and reducing your chances of losing. And that's huge compared to the people that don't know how to do that are just picking stocks to hope they go up and they go down instead. And they're going to be out. The market's down 30%, they're going to be out 40%. They'll be lucky to be out 30%. If you watch these mutual funds, most of them, the market's up 30% and the mutual fund's up 20%. Well, hey, you didn't even beat the market. You could have bought all the Dow Jones stocks or S&P 500 stocks and did better than that, And then when the market's down, guess what? The market's down 20%, 30%. They're down, 40%, So they're not going to beat the market either. So most mutual funds, unfortunately, will not beat the overall market. And then you'll see an ad. We did 100% return, 60% return. Our mutual fund beat the market. But what they're not telling you, am I coming through?
Yeah.
What they're not telling you, Mark, is that particular mutual fund made 60% return. Great. But they're managing another 100 mutual funds that lost money that didn't make 60% return. They're just giving you the top mutual fund that they made that probably nobody was in it. And the moment you go into a mutual fund that makes 60% return, the next year it's going to be minus 5%.
Yeah.
So there's no guarantee you're going to beat the market. The guarantee is going to be in your skill at picking stocks. If you can forecast these stocks, if you can know how to eke out premium from cover calls, if you know how to pick some decent dividend stocks that aren't going to get killed in the bear market, if you know how to do mild trading, if you can pick the peaks and the valleys better than the next guy, you're going to do good. Easier said than done. Show me 3 months of trading where you're successful. Show me 6 months. Show me a year you paying taxes on your profits. Show me 3 years you paying taxes on your profits. You're a successful trader. Write it down. 3 years, back to back, paying taxes on successful trading profits. Trading profits proves you are a real trader.
You said
Follow me.
You said 3 years back to back.
3 years.
Paying
3 years.
Yeah.
Paying taxes on your profits of trading. That proves you're a real trader. That's just a bar. You can have your own bar. But what most people do, month one, hey, I did good. I had about 50%. Month two, got killed. Man, damn, I went broke. You didn't even make it the year. So, tongue in cheek, when you're talking about, oh, I make so much money. You hear these people, oh, I'm doing trading. Yeah, and it's a bull market. Oh, I'm in Tesla. I made so much money. Yeah, then come give him a call 6 months later, 18 months later, a year later, the market may turn. He's like, oh man, I went broke, man. Lost my house. That's what they'll do. People will take a mortgage on their house because they're doing so great in the market, put it all in the market, put it on the dog shit penny stocks, long call options, and lose, and then they have a big debt and they can't really pay it. Market turns, they get killed. Oh man, I had my day in the market, man. I got hurt. Never going back. Stocks are a scam. So make sure that's not you. Make sure you have a plan. What's your plan? You got a core 10. You're gonna trade these stocks. You're gonna outperform the market. You know how to do cover calls. You know how to do mild trading. You know how to do options. With a small percent of your account, you know how to have a little foundation for dividends because dividends are nice. Income, steady income. You want to have different income streams. Dividends, cover calls, trading. You don't want to just have one income stream. You want to have great stocks. You want to have profitable stocks, high price, right? Good, healthy, favorable PE. Price is going up. Right? High share price. $100 a share, $200 a share. Chipotle broke $1,500. Did you catch that?
Yeah.
And if they have 300,000 volume, that's really like a stock that's 1/10, $150 that has 3,000. I'm sorry, that has 3 million volume. To follow me, and if the stock price is 10 times, and the volume has to be 10 times commensurate. So that's like a $150 stock with 3 million volumes. So I say Chipotle qualifies. Yes.
Yes.
And you'll notice that, even in a bear market, you'll still have stocks that go up. And I want you to really look at these stocks that are going up in the bear market, and I want you to really take note because they're doing something different. They're better. You can say recession proof, whatever you want to call it, but they're going to be there. You're gonna find them. Apple's nice and big. Apple's not going away. It's a kind of a safe bet. It's not going to give you the return of Tesla or Roku, but it's a safer bet. Tesla or Roku can come down even if they're in play. GameStop, those are really risky because there's like a circus going on with those guys shorting and going long. So don't bet on long shots, bet on sure things. Someone's going to give you $1 million, but that money is going to be their money they save for their whole life, for their college, for their kids' college. So you can't just put it in call options. You gotta be safe. You gotta be responsible. You gotta have criteria. You gotta have standards. We can't buy crap. We can't afford to buy crap. We can't afford to gamble. We have to bet on sure things. We probably know that they're going to do well. We don't know for sure. If I'm getting $2,000 a month on Netflix, that's what I'm doing. You can how can you not like that? You give it up the upside, but what upside? If the market comes down, there is no upside. So the upside is just to say, might happen, might not happen. That's why you write a cover call. People tell me, are you there?
Yeah.
People tell me, oh, don't write a cover call Netflix because it does so well. Well, hey, you know, I'm getting $2,000 a month. Tell that to my car note that I already got paid off. Tell that to my mortgage that's paid off. Don't worry about upside. I don't need a potential upside that may not come. I want the money right now. I'm gonna get that premium for the cover call, $1,700, $2,000. Sometimes the cover call will dry up in the sense that when you were getting 3.5% 1 month, now you start getting 3%. You see, when you were getting 5%, now you're getting 4%. So the option premiums sometimes dry up if it gets kind of like a lackluster market.
Mm-hmm.
So that 3 to 5%, that may change. It's not going to be always like that all the time. Sometimes it'll go up. It'll go to 4 to 6%. Then we're like high-fiving and jumping on our table, with, you know, and we get a good stock like Tesla, we can write cover calls on that, you know, for 8%. If you have the balls to do that, you know that it's overvalued, at least it's highly valued, so it could come down, you know. But we have standards, we have criteria, we follow that, we make money, and that's what we're doing. Any questions on that?
Nope.
We can wrap up a little early today. I want you to focus on review, because we're going to go into the later sessions, and before I introduce new information, I want you to know the foundation like the back of your hand. I don't want you to introduce new information and you don't know this stuff. Yeah. I want you to write your stocks out by hand. I want you to show the volume, the change, the price. I want you to have your core 10 there, study your core 10, so you don't have to study 2,000 stocks. So you don't have to listen to Kramer for every new flavor of the month. Mm-hmm. We can talk a little bit more about trading. You know, we talked about looking at the peaks and valleys, right? If the stock moves 10 points, it goes up 10 points, then it sells down, then it goes up, right? You see these channels, these 3-month channels. You showed me 1 year chart, 6-month chart, 1 month chart, right?
Yeah.
If the stock moves 10 points, try to get 5 points, right? That's a 5-point gain. And if you can get 5 points, would it be easier to get 3 points? I need you to write that down. I need you to see that on your notes. If a 5-point trade is the plan, would 3 points be easier, safer, higher accuracy of being correct?
Percentage gain versus accuracy.
Yes. You know, because the more, and what does the public do? They buy a stock and they go, oh, okay, I'll buy it at 80, so I guess I'll sell it at 200. I don't know. You know? So who's going to get their goal faster?
Exactly. And
then when the public, you know, when the stock gets to 200, they'll be like, well, I don't know, I guess I'll buy more, you know. So they have no rhyme or reason. We have a plan. We're getting income. We're trading. We're analyzing our stocks. We have criteria. We're not throwing darts at a board. That's the difference. Okay. I want to explode your brain. Think about think to yourself about what kind of size account do you want to be managing. This is your own personal thing. You know, if you have that size account, what kind of portfolio are you gonna? Is it gonna look like? You know, are you gonna have? If you have X dollars, you're gonna have your certain stocks, your certain trades. So that's called a portfolio. So we're gonna talk about portfolio next week. I want you to write a scenario where you have a portfolio, you're managing X dollars. I want to see what it looks like, and I want to use our teachings, right? And you need to be able to present this, you know, to Mr. Morgan, to your clients, and look, this is kind of where we are. This is what we're doing. I expect to get this much money on dividends. I expect to get this much on cover calls. Make sense? Mm-hmm. You're not just trading like random trading. Oh, look, it's 6 o'clock. Let's make 6 trades. Buy, sell, buy, sell, buy, sell. Did we win? Oh, damn, we lost money. You know, day traders will do that. They'll just no rhyme or reason. So we have a plan. We have a criteria, and we follow it, and we get the result, and that's it. And just repeat. So think about a portfolio with X dollars, and I want you to work on that.
I already have all the numbers and the percents already. I just wrote down quickly for my
Good.
hypothetical.
Good. I'm gonna see that maybe middle of the week, and then we'll discuss it next week. Sound good?
Yeah, I'll send you a
picture. That's a sign of how you can manage money, you know. And if you manage your money, you're gonna get a percent from that, whether you're getting percent of the trade or a fee, or maybe it's your own money, you know. But and then we're looking at getting 3 years of profits where you're paying taxes, and that proves it.
Mm-hmm.
Sound good?
Yep.
Okay, Mark.
Take care, Eric.
All right, thank you.